Hi, this is Charlie Aiken of investmentmatters.club. We've an interesting mix here entitled The Billionaire, Wimbledon and the Yen for Gold. Britain's best known billionaire was in the news this week, stating that a no-deal Brexit would cause the pound to plummet and be worth the same as the dollar, 1 for 1, better known as parity, which was last seen in April 1985. Sir Richard, the billionaire, went on to say that the fall in sterling since the mid-2016 referendum has caused large losses for his UK companies, going on to say that it would be also devastating for many other British companies should the currency continue to fall on the back of a no-deal Brexit. So, is he correct? Well, as always, we prefer to look at the charts because charts don't lie. They're a summary of the past and also provide a peek at the future. Here we have sterling euro as opposed to sterling dollar from our currency website known as currencytiming.com, and as you can see, a full 6 months before the mid-2016 referendum, in fact in December 2015, the pound euro rate was at 142 and had already started to fall and was substantially lower by the time of the referendum. So the referendum can't really be blamed on the currency falling. Likewise, if we switch across to pound sterling, again at the end of 2015, when the pound dollar at the end of 2015 was the best part of 180, and that had fallen substantially by the time of the referendum. So on both counts, both currency pairs had already been falling before the referendum. So it can't be that. So I'm sorry, Sir Richard. The fact is that whereas most human beings extrapolate what the immediate past has been as far as financial instruments are concerned and then project that forward, the reality of it is that financial instruments are fractal in nature. In other words, they form patterns, and those patterns repeat themselves over all degrees of time, whether you're looking at minutes by minutes or decades by decades or indeed century by century. They do repeat the same patterns. In this case, which is a 50-year chart going all the way back here, look to 1970, you can see that sterling's been falling against the dollar for the whole 50-year period, or at least trending lower. So you could actually tongue-in-cheek say perhaps the cause of the sterling slide is entering the European Union back here as opposed to what's happened just in the recent past. But either way, by projecting 6 to 12 months forward, we can have a pretty good idea from this pattern, which is known as a sideways triangle, about where this exchange rate pair is going, whether it's going lower or indeed whether it's going higher. But either way, I can guarantee whatever the move is, it's got nothing to do with politicians, the central bank, Bank of England in this case, or indeed Brexit, no deal or otherwise. This week has also seen the winding up of the 133rd Wimbledon Tennis Championship, with today being a fantastic ladies singles between Simona Halep, who beat Serena Williams to win the purse, which is now equal with the men's prize of tomorrow at 2.35 million. Compare this and spare a thought for Anne Jones, the Brit who beat America's Billie Jean King 50 years ago in 1969, with the then purse of £750. Wow, some difference between the two sums. Yes, in between time there's been a huge increase in media rights and the money that's in sport alongside of sponsorship. But part of this will have been on the debasement of the currency that we've seen really globally in nature, which has been at the hands, certainly in the last few years, of central banks, including the Bank of England, where they've been quite happy to see the currency debased to try and give themselves or give their economy a stimulus to try and get some better economic growth of what's been seen post-financial crisis of a decade back. You will see a link through this overview called The Pound in Your Pocket, which was written back in May 2007, which gives further insight to the debasement and of what's gone on in the last 50 odd years, and also says a bit there about central banks and interest rates in general. Whilst it's important to look at pound sterling and indeed pound dollar, a far more important currency relationship is that of the US dollar Japanese yen. And there are lots of reasons for this, including the fact there that lots of the carry trade, which means big institutions borrow money in Japanese yen and invest it into other currencies with a higher interest rate. Hence they get an improved return on interest rate, but of course there is a currency risk on what they're doing. But either way, what interests us here is December 2012, marked by this blue line, which is when Prime Minister Shinzo Abe was re-elected for his second term. And he was elected partly on the economic policies that he advocated, better known as the three arrows of monetary easing, fiscal stimulus and structural reforms, which The Economist magazine characterised as a mix of reflation, government spending and a growth strategy designed to jolt the economy out of the malaise of more than 2 decades earlier, which followed the credit bubble of late 1989. As an aside, as can be seen in a chart of the Japan's Nikkei 225 index, the peak for the stock market was at the best part of 38,500 in late 1989, and here we are 30 years later, and the index is still a huge 45% below the level of back then. So, bearing in mind that the stock index is a lead indicator on economic growth, the three arrows policy of Abe could be seen to have improved matters, but in reality the policies have actually failed, because although the currency was debased by 66%, which was actually nothing to do with Abe, again it was because of the fractal nature of the financial instrument that we're looking at, we still have, instead of reflation, we've got inflation still knocking on negative territory. We've got 10-year bonds at minus 0.1%, and you've still got pretty pedestrian economic growth. But either way, looking at this particular chart, we have a similar pattern here, although I haven't put the two trend lines on there, similar to what we saw with pound sterling, and that is we've got a developing triangle here, a sideways movement between 125 there and 100 here. At the moment we're sat neatly nearly midway at about 108. So this tells us much about where the currency is likely to go, and either way there's a interesting relationship between that particular currency pair and the dollar gold price. Now, just to hopefully not confuse things, matter, because our charting system allows us to do this, the correlation is inverse. So in other words, as sterling, I beg your pardon, as the yen gets stronger against the dollar, then you can see that the price of gold goes up with it, and vice versa. If the yen weakens against the dollar, then the price of gold falls. So there we have it. Hopefully it's been of interest and gives some guidance in what can be a complex area to put across, but hopefully I've tried to make it a little bit easier to understand, and it does tell us much about what to expect going forward in, just to summarise, not just pound sterling and pound euro, but more importantly the dollar yen rate and the price of gold. If you would like the full report as a PDF, then you can obtain that by completing this page here.